There are many ways to invest money: stocks, ETFs, bonds, real estate, crypto, and commodities. But most people don't fail at investing because they picked the wrong one. They fail because they never fully understood what these investments actually are. In this video, we're going to break down the main types of investments, what they do, how they work, and why people use them. Not to tell you what to buy, but to help you understand your options. This is not financial advice, this is education. Let's start with the most common one. When you buy a stock, you're buying ownership in a company. If you own one share of a company, you own a small piece of that business. If the company grows, it becomes more profitable or more valuable, and your share can increase in value. Most people think stock investing is complicated. It's not. At its core, investing is simply owning a piece of a business and letting that business grow over time. Let me show you exactly how your money increases when a company becomes more profitable. Let's say you invest $100 in a company like Apple, for an example. The stock costs $10 per share, so you buy 10 shares. At this point, nothing magical is happening. You just own a small piece of a real business. Over time, the company starts doing better. It sells more products, cuts unnecessary costs, and it becomes more profitable every year. Let's say the company's profits double in a year. This matters because profits are what make a business valuable. As the company becomes more profitable, investors notice. More people want to own part of the business. Demand for the stock increases. Because of this, the stock price rises from $10 to $20 per share. You still own 10 shares, but now those shares are worth $20 each. That means 10 shares times $20 equals $200. Now, your original $100 investment is now worth $200. You didn't add more money. You didn't trade. You simply owned a growing business. Each share of stock represents ownership in the company. When the company makes more money, each share becomes more valuable. That's why your investment grows when the business grows. Now imagine that you purchased from the company when each share was low, and now, years, months, or even weeks later, the stock goes up. Some companies also pay dividends. Dividends are cash payments made to shareholders from company profits. If you reinvest those dividends, you can buy more shares, which means more ownership, more future growth, stronger compounding over time. This is how investing really works. Not overnight, not by guessing, but by owning strong businesses and giving them time to grow. Small amounts, long time, real results. Stocks generally make money in two ways. Price growth. The stock becomes worth more over time. Dividends. Some companies pay shareholders a portion of profits. Not all companies pay dividends. Remember, some reinvest profits back into the business to grow faster. Stocks can offer high long-term returns, but they can also be volatile. Prices go up and down, sometimes dramatically, especially in the short term. Over the last century, the U.S. stock market, measured by the S&P 500, has grown significantly, averaging a total annual return of approximately 10% to 10.5%. Stocks started to fund businesses, and understanding that explains why wealthy people have been using them for centuries. Hundreds of years ago, starting a large business was expensive. Exploration companies, shipping companies, railroads, and factories needed huge amounts of money up front. So instead of one person paying for everything, businesses sold ownership shares. If you bought a share, you owned a piece of the company and shared in its success. That's the birth of the stock. As more companies sold shares, people needed a place to buy and sell them. This led to the creation of organized markets like the Amsterdam Stock Exchange, the world's first official stock exchange. Later came major markets like the New York Stock Exchange and NASDAQ. These markets made it easier for everyday people and wealthy investors to participate. When you buy a stock, you're not betting on a number. You're buying ownership in a real business. That business might sell products, provide services, own factories, software, or real estate. They generate profits year after year. Some of the most well-known companies in the world are public companies with stocks, companies like Apple, Microsoft, Amazon, and Coca-Cola. Wealthy people invest in stocks for a few simple reasons. First, stocks scale. You can own parts of thousands of businesses at the same time. Second, stocks grow with the economy. As populations grow, technology improves, and productivity increases, strong companies grow alongside it. Third, stocks produce income. Many companies pay dividends, creating cash flow without selling the investment. And finally, stocks compound. Reinvested profits generate more profits, which generate even more profits over time. This is why long-term investors outperform short-term speculators. The stock market goes up and down, but ownership in productive businesses has historically increased in value over long periods of time. The wealthy understand this, so they focus on decades, not days. They invest in businesses, not hype.